Greetings. This information was compiled for the r/IRS Reddit community and anyone interested in offshore retirement accounts. The IRS reminds U.S. citizens that they are taxable on their worldwide income unless they can establish there is a statutory or treaty exemption. The IRS continues to pursue taxpayers who attempt to conceal income in offshore banks, brokerage accounts, digital asset accounts, and nominee entities. To complement its enforcement investigations, the IRS requires individuals holding foreign assets and third parties to report to the IRS on foreign assets, foreign accounts, foreign entities, and digital assets. Once a British colony, the tiny island nation of Malta, with just under 500,000 people, became independent only in 1964. Some have labeled Malta a pirate base for tax avoidance. The Paradise Papers have also cited Malta among a list of tax havens. Though local companies pay a corporate tax rate of 35%, some outside entities pay only 0 to 6% in Malta. The International Monetary Fund estimates that tax havens cost governments almost $1 trillion yearly, mostly in uncollected corporate tax revenue. Moreover, at least 366 companies in the Fortune 500 have at least one subsidiary in a tax haven. Predictably, Malta pensions have also caught the eye of the Internal Revenue Service. Originally cross-border specialists concurred that the 2011 U.S.-Malta Treaty's language provided unusual tax benefits. Malta exempts pension payments its residents receive, so the treaty requires the U.S. to exempt certain payments from U.S. tax. How's it work? Here's an example. Let's say there's a 49-year-old U.S. resident with a highly appreciated cryptofolio and shares of a startup about to go public. These assets have a cost basis of $100 million. After the IPO, the assets could have a total value of $1 billion. As part of their retirement planning, they contribute these assets to a Maltese pension account, allowing them to receive large contributions of appreciated assets. This person then sells both assets and has almost $1 billion in their pension account. Under Malta rules, they only need enough assets to provide a pension payout of sufficient retirement income, but meeting that threshold isn't hard when you have that much money. They'll eventually owe tax to Uncle Sam at ordinary income rates on the part of the initial payout. But this person doesn't have to withdraw immediately, and the assets can grow tax-free. Based on the original Maltese criteria, if a person is wealthy enough, they can take large withdrawals of excess funds as lump sum payments once they turn 50, even on assets with a lot of untaxed appreciation going into the plan. These payouts were free of Malta and U.S. tax under the treaty language. As a result, this person could withdraw $700 million or more, tax-free, within 5 years of setting up their plan, withholding about $170 million of U.S. tax. They could also take further tax-free withdrawals annually after that. In addition to an IRS crackdown, the Treasury Department seeks changes to the Malta Treaty. But let's not leave out some of the other offshore tax havens to keep an eye on. The Bahamas, Bermuda, British Virgin Islands, Cayman Islands, Channel Islands, the Isle of Man, Ireland, Luxembourg, Mauritius, Monaco, Netherlands, Singapore, and Switzerland. Good day.